Ladies and gentlemen, thank you for standing by, and welcome to the State of Financing Markets for Private Equity. During the presentation, all participants will be in a listen-only mode. Should you wish to ask a question during the presentation, please use the chat feature located in the lower left-hand corner of your screen. If you need to reach an operator at any time, please press *0. As a reminder, this conference is being recorded. Monday, November the 16th, 2015. I would now like to turn the conference over to Michael Manley. Go ahead, Michael.
Thank you very much. Good afternoon and good morning. Welcome to our webinar, State of Financing Markets for Private Equity Companies, hosted by Venable LLP. I'm Michael Manley, a partner in the corporate practice group at Venable. I lead the firm's fund practice, and I have the pleasure of moderating this panel. First of all, on behalf of myself and the panel, our thoughts and prayers are with the people of France today. We have assembled a distinguished panel for today's discussion. First, we have Rafael Castro, who is a senior principal of the Credit Supported Loan Fund at Enhanced Capital. Founded in 1999, Enhanced Capital is a New York-based, diversified private investment firm focused on companies overlooked by traditional sources of capital due to location or size. Through its ArchNote product, the Enhanced Credit Supported Loan Fund solves equity needs of end-of-life sponsor-backed portfolio companies with non-dilutive debt. Mr. Castro is responsible for sourcing, executing, and monitoring the firm's debt investments. Next, we have my partner and colleague, Chuck Morton, who is a partner at Venable and co-chair of the corporate practice group. Chuck has a national practice advising on M&A and financings, including all types of equity investments. Chuck is a past chairman of the Global Board of Directors of ACG and has been recognized repeatedly by Legal 500 as one of among 20 leading lawyers across the United States doing middle market deals. Next, we have Randy Schwimmer, Senior Managing Director and Head of Origination and Capital Markets for Churchill Asset Management. Churchill Asset Management is a leading provider of senior and unitranche debt financing to middle market companies, primarily those owned by private equity investment firms. Churchill is part of TIAA-CREF, one of the largest global asset managers across multiple asset classes. Mr. Schwimmer supervises origination and capital markets for the firm. Finally, we have Stefan Schaefer, Managing Partner of SPP Capital Partners. SPP Capital is a recognized specialist in structuring and raising private debt and equity capital for its corporate and equity sponsor relationships. The firm's transaction experience includes more than 500 transactions aggregating more than $23 billion for acquisitions, growth capital, recapitalizations, refinancings, buyouts, and sales of secondary limited partnership interests across a diverse array of industries. Mr. Schaefer manages the global origination of SPP Capital. So I want to thank all the panelists for joining us today. The leveraged finance markets continue to present interesting challenges for market participants, including private equity companies. Macroeconomic uncertainty and market volatility have contributed to higher borrowing costs and fundraising challenges throughout the PE market. Our panelists today will discuss some of these challenges, including an overview of the current status of the private capital middle market, some of the biggest changes in the middle market this year, financing alternatives employed by PE funds, and how all of these elements are impacting deal activity and deal structure. We hope this panel will be interactive in the virtual sense, and we will have time for questions at the end of the presentation. So now I'd like to turn it over to my panelist, Stefan Schaefer, to begin this presentation.
Thank you very much. My comments today are going to sort of take a look at where we've been, where we are, and some changing market conditions, and where we're going into 2016. I'm then going to comment on some of the products that we see developing in large part because of where we've been. This first slide that we're on is going over, there shouldn't be any surprises here for anybody. I think everybody understands that the last 3 years have been epitomized by a very, almost excess liquidity conditions. The market's been characterized by cheap money, very aggressive terms, and relatively permissive uses of capital, meaning both accretive uses, acquisitions, growth capital, as well as non-accretive uses of capital, that being dividend recaps, share repurchases, straight leverage recaps. Probably the one thing that is notable on this first slide is the fact that as we get to 2015 on an LTM basis, you can see that the actual number of non-accretive uses of capital has actually shrunk to about 49. Now, that may change between now and year end, but to the extent you're looking for a little bit of a trend, it might be that we're just beginning to see on an LTM basis the fact that the market is tightening up a little bit. Going to the next slide, you can get a sense of where we are now. This is going over an LTM period, and the market really looks like it does most years. You see a peak in activity in 12/1 of 2014, and that's driven by year-end closings that we see every single year. And then things slow down a little bit, of people getting ready to do new deals into the market, and then we see that sort of typical build of closings throughout the year. The deals that were brought to market in January and February all of a sudden start closing in April, May, and June, and you see that that buildup in activity, and then you go back into the summertime, and it sort of slows down again. And then as we get into Q4, again, more of a building of activity. What's probably more notable now than we've seen in the past is look at the number of recaps for the period 10/1/2015, or non-accretive uses in capital, and you don't see one in that category as less than $250 million, suggesting that something of a trend may in fact be beginning, and things are in fact changing.
This is Chuck. Do you have a sense as to why that would be happening? You sort of alluded to one possibility, which is credit is tightening. Could there be other explanations as well?
Well, sure there are. I mean, I think I'm going to focus probably more on credit tightening, but absolutely. One of the things that might be is that to the extent we've seen such a buildup of M&A activity over the course of the last, 2 years, 24 months or so, that before where people weren't selling their companies, they'd be recapping them. So they'd get the returns on their capital that way. But end of fund, everything else, people want to all of a sudden start selling these portfolio assets, so you may in fact see a sale of an asset which wouldn't come up here, obviously, as a recap. And so that's probably one of the hidden components that's in there as well. And as we all know, M&A activity has really, especially in the middle market, has really been a significant driver in transaction flow. So that's clearly, that's probably one of the things in these numbers. But the one that's probably a little bit more notable is that the credit environment is changing. And it's a really nice graphic here as to what's going on. And let's just look at where we are right now. And this is sort of, as of October of 2015, you can see that there have been 10 upgrades and 50 downgrades. And if you look really through the last year, there is a preponderance of downgrade activity, real weakening of credit, as it were. And I think that's not lost on anybody. A lot of that's being driven very specifically by energy and mining. That's a good chunk of that. You take that out, and it actually probably looks more normalized for last year's, but it has been pretty strong. The other thing is that if you look at the default rate through this year, right now we're at about a 2.9% default rate, but Fitch, and I'm going to stay with that right there, and normally in a non-recession environment, the default rate is about 2% per year. So we're actually already above what would be a traditional non-recessionary default rate. And if you look at where we're going on that, right now we've got both Fitch projecting 3.5% default rate by year end, and S&P projected 4.7% in 2016, which means that we may have hit the high water mark as credit strength, and that we're seeing a gradual deterioration. So what does that mean, and how are banks responding? On this slide, you can see that the Federal Reserve, October 2015, Senior Loan Officer Opinion Survey, for the first time since 2011, the net percentage of domestic banks reported a tightening of terms over the last 3 months. And you can see, what is that attributed to? Just what we were talking about earlier. 31.6% basically look at worsening industry-specific problems. You're also seeing, along with tightening of terms, an increase in pricing, and that's the little areas that are circled. So clearly there is a movement here, and that I think people have to get used to the fact that we are seeing something of a sea change in not only credit, but a real rationalizing of credit risk, into the market. Putting us really, when we're out there doing deals today, what are we seeing? Well, there's no doubt when you look at middle market specifically, who are the two of the largest constituencies in providing capital to middle market funds? Commercial banks and then the business development companies. Banks, clearly, as we noted earlier from the survey, that banks are in a more conservative mode. But I think more importantly, if you look at what's been going on in the banking industry, specifically leverage lending guidelines that were first published in March of 2013, and that sort of everybody started looking at them and started wondering what are they going to do, started tightening credit a little bit. But it really wasn't until November of 2014 when there was a revision to leverage guidance and a real message from the Fed that they are serious about credit risk and that they wanted people to be more conservative. Most of us know that in things like deals that are outside what we call the 3x4 box, 3 times senior leverage versus 4 times total leverage. And I think right now, by the time we've gotten from November of 14, when those rules were first, when the guidelines were first promulgated, to where we are today, is that this has really worked through the market. Now, the weird thing is that it doesn't mean the same thing to every bank. So there are some banks, for instance, that will say it's a non-pass asset or something that would be outside that 3x4 box, not because leverage is in fact above the 3x4 time guideline, but because it ends up in a negative net worth. There's a lot, and it's not universal, and different banks are looking at it different ways, but the one thing that we have consistent from almost any credit committee in any bank is that people are taking a harder look. It's harder to get things through a committee. Will banks do beyond 3 times senior and 4 times total leverage deals? Absolutely, but they are going to be pretty strict about which deals get it. Which means a couple things in the banking market. One, when it comes to leverage lending, commercial banks are stepping back. I think most people are seeing that, but it also means that when deals are not outside that guideline, banks are getting exceedingly competitive to get those assets, those low leverage assets. So where pricing in the market used to be LIBOR 3.5 to sort of 4.5 for most leverage lending, when you have something that's within the box and it's a nice credit and non-cyclical, all of a sudden you're going to be seeing deals getting done at LIBOR 2.5 for cash flow deals. The other big community that we're seeing big changes coming in is the BDC community, and that's really more of a market-driven thing. Business development companies, about 70% of them today are trading at a discount to their net asset value, and accordingly there's going to be greater scrutiny on the BDC community with respect to what they're investing in and what's in those portfolios, and that will affect their share price. Share price is the lifeblood of a publicly traded BDC, and accordingly there's going to be real scrutiny on credit quality. And what does that translate to? Just like in the banking market, it means that certain sectors, energy, mining, minerals, are going to be a little bit out of favor. Highly leveraged transactions are going to be out of favor. It also means there's going to be that much more competition for the assets that everybody wants. So when we look at the market today, there's no doubt that you're seeing a real reduction in typical leverage requirements. It's going to take some time for people to get used to, but it's out there. Who's going to be hit first? Lower mid-market issuers. I mean, one of the unique things about this market has been for a long time that companies with $5, $7 million of EBITDA were getting terms and conditions that we usually reserve for companies that were $15 million of EBITDA. I think the new sort of critical mass in EBITDA is probably about 10 million, probably trending up from about 7.5. That's anecdotal. I don't have anything to back that up other than what we're seeing in the market. But pricing, the one thing I do want to note is that while we have seen these sort of sea changes in the market is in fact still stubbornly very competitive. So it's not universal. It's still a good market. I don't want to dissuade people from coming to the market. It's just a realization that things are going to be changing. And when you look at some of the, where we're going with this, Blair did their Q3 leverage finance market update, and in that you can see a growth in people who expect pricing to increase, went from 6% in Q3 to 49% in Q4. And as far as leveraging and conditions tightening, you see in Q3, 9% of respondents felt that way, and that went up to 46% in Q4. So, and that's really what we're going to see in 2016. finally, how do you respond to what's going on in the market? And I think the two areas that we're focusing on, that we're seeing a lot of excitement right now, is non-sponsored structured equity products. And what I say by that is that obviously if you can't get another dollar of debt in a deal, you're going to look for that next piece of capital that you can get in a deal, and very often that's going to be a piece of equity. The two types of equity that we are doing the most at SPP there sort of breaks down to two categories. One is sort of below-the-line sub-debt. It's basically something that's like a redeemable preferred. It has an 8% PIK dividend. It has warrants. It sort of looks like sub-debt of the 2004, 2005 vintage. Its return is sort of like a, sort of 16 to 19%. And when you do that, you're not really solving for a dilution or pre-money, post-money analysis. What you're doing is you're basically saying, if I need to clear 16 or 17 or 18% in the market, how much of the company do I have to give up? How big is that warrant to drive that IRR? The other side of it is that very often you're not going to do a structured piece because there are limits on people who are doing a unitranche or sub piece, how much they'll do as sort of an adjunct equity piece, part of their deal. And then you get into something which is more a piece of common with a promote. So you're basically heads up with either an independent sponsor or a sponsor, and you basically give them sort of once an 8% PIK dividend has been achieved, then they're basically getting a sort of a promote for another 15%, and then sometimes it'll step up, and it sort of goes where it's at. Interesting, in a Preqin analysis that came out recently, 69% of the GPs in private equity were willing to give up LP co-investment rights or co-investment rights into a structured basis like this. I think to the extent you're not going to be getting 4.5, 5 times leverage for these middle market deals, there is a great market developing and growing. It consists of insurance companies, of credit opportunity funds, of family offices who really want to play in equity in these structures in middle market. The other place we're seeing is a little bit of growing structured senior debt instruments. And this comes along the line of sort of the last out pieces, deals where you're not going to get as much senior as you have. The banks don't want to step up over 3X. But maybe what they'll do is they'll be at 3X on their piece, and there'll be a last out piece from a separate provider. I'm not talking part of a bank syndicate in the middle market. I'm talking about a separate provider of capital who will do a last out term B piece. Pricing on that could be anywhere between LIBOR 7 and LIBOR 11 or 11 to 12%. And it sort of wedges itself in between what might be a high yield below it and the mezzanine side. It might be sub-debt, but it'll sort of wedge itself right in between that senior, maybe an ABL revolver, and that other term debt or mezzanine term debt.
Stephen, one of the things that I've thought that these co-invests reflect, and I'd be curious to hear your thoughts about it, is simply a way for LPs to try to push back on fees. So if they get the co-invest and they don't necessarily have to pay for the funds under management, that in essence it's a backdoor way to get the returns without paying the manager.
I think that there certainly is a movement. It's been there for some time, and it's grown over the last 5 years, where there are traditional LPs who were normally passive who are coming into that. But really the change here is that we're talking about people who are not LPs. We're talking about just other family office funds or insurance companies or other really investors in equity. And there's a real viable market. If you don't necessarily, I think normally an equity sponsor, to your point, is going to, the first place you're going to go, if your go-to guy is going to be your LPs, because that's a way to return the favor to them putting money into your fund. But it doesn't have to be there. And the reality is when you do it outside your LPs, you're probably going to get better economic terms than you would with your LPs because you don't have that sort of competition as to, because you're really selling an asset in an auction as opposed to bringing in a friend.
All right, Stephen, thanks. We're now going to turn it over to Randy Schwimmer for the next segment of the presentation.
Thank you, and thank you to Venable, Mike and Chuck for hosting. I thought Stephen's summary was terrific, and if you don't subscribe to his monthly summary of deal terms and pricing, you should, because he's done it for a long time, and nobody does it better. So you should definitely hook up with SPP on that. I think that his summary of the sort of macro themes is definitely resonating with a lot of investors in the market. And these themes, such as defaults in the energy-related sector, some of the cycle-related concerns that investors are seeing playing out with certain credits, as well as the overhang on the banking sector, are all acting, one would think, to be curbs on credit enthusiasm. But what we're finding, and our focus, as Mike said in the beginning, is really middle market, senior debt with private equity-backed companies. The reality of what's going on in the middle market and the overall tone continues to be very issuer-friendly. And what I thought I would do is just focus on, for the few minutes I have, to why that's the case. And to a large degree, it's being driven by the supply side of the equation with regard to the amount of capital, both private equity capital from sponsors and private non-bank credit that's being raised in the market. Private equity capital, there's at least $500 billion of uncommitted cash that's been raised over the last 5-6 years by private equity funds through their LPs. That money needs to be deployed, so there's significant pressure on the behalf of sponsors to put that money to work. At the same time, as Stephan said, the bank regulations have put a damper on what's going on in the bank market, and private non-bank credit has rushed in to fill the void. Those combination of factors are creating a very frothy environment for overall deal terms, and we'll talk about that in a second. To a large degree, that's being reflected by both leverage and pricing. But what's interesting is if you actually look at the sponsor activity, and this is actually the last question on page 10, that the drive to commit capital by the sponsors is resulting in a number of things. We mentioned valuations. That's one element, and anyone who's seen any PE-driven purchase price multiple data of any kind sees those numbers going up pretty significantly. For the larger deals, double-digit purchase price multiples is not uncommon. In fact, at the high end, we've seen deals in 15, 16, and 17 times multiples. That's number one. Number two, we're seeing significant compression of the timetables related to getting deals done. So in the old days, sponsors would have 3, 4, 5, 6 months to get deals done. Now it's measured in weeks instead. The result of that is a tremendous compression of the timetable to get due diligence done. One of our sponsored clients said that his competitors were, quote, acting as if they needed to close the deal to find out exactly what the company does, unquote. I'm not sure it's always that bad, but there does seem to be a rush to get deals closed, particularly to get deals taken off the table. And in that regard, it drives what's going on the financing side because sponsors are looking for speed and certainty of close. Stephan had also mentioned the one-stop financings and unitranche. I would say that's probably one of the biggest changes that we've seen in the middle market this year. The number of providers who have gotten into the market to provide either a one-stop shop or bifurcated at the back end into both a first-out and last-out tranche, those deals are seeing significant activity. It makes it easier for the sponsor because they can go to one provider. There's no market flex, no intercreditor agreement, and the ability to write the check and not have to syndicate the deal. In our newsletter that we left, we just published a one-page, actually it's a 3-page report comprised of the special issues that we've done on the unitranche. So you should take a look at that on theleadleft.com. That talks about the unitranche activity, but that's a big change as well. The other thing related to it is obviously the sale of GE Capital. With regard to the sponsor finance business, Antares going to Canadian Pension Plan, I think there was a view when it was first announced in April that it would create more disruption in the market than it in fact did. The transfer from ownership from Antares from GE to CPP was actually pretty seamless, but it did unleash a lot of competition, sort of raised the animal spirits in the middle market credit space with a number of providers such as Gala, Berries, American Capital and others stepping in to fill a void which really never materialized. But the news for sponsors and issuers is that that market became increasingly competitive. So then turning to just pricing and terms for the market, the result of the amount of capital coming into the market, the amount of competitive efforts related to both the Antares deal and their competition is that pricing has continued to be pretty darn attractive for issuers. And I will say that terms in general are very size specific, that the market has bifurcated between what I would call the haves and the have-nots, and also between the small cap and the larger cap middle market deals. As Stephan mentioned, it's very specific with regard to size. I would say for companies in the EBITDA range of kind of 15 to 20 in the low end, up to sort of 40 to 50 at the high end, that is below what I would call the syndicated larger middle market. Pricing has been in the kind of 450, 475 range for the 1% floor for what I would call the haves. Those would be the good credits with good sponsors, good businesses, and then priced up from there to the 475, 500 range, depending on leverage and case specific. So that would be for first lien, kind of first out structures, with second lien kind of being about 400 basis points wide of wherever the first lien is, so kind of in the L plus 850 range on up. With regard to leverage, I would say 4 and 6 is the new 3.5, 5. Remember the days when we were quoting 3.5 senior, 5.5 total? Well, for the better credits, we're seeing easily 4 and 6. And part of the frothiness that I described earlier is pushing some of these deals to even higher levels, to the mid to high 4s senior leverage, and even close to 7 times leverage. Now, the argument by the sponsors has been, well, if we're paying 14 times for this company, you've got a significant amount of capital below you. And that is the case. We are not seeing any diminution. In fact, we're seeing an enhancement of the amount of equity per cent of capital in these deals, anywhere from 40 to 50% and even higher. So from a credit perspective, that's heartening, but this still is pretty toppy leverage at 6 and 7 times. And those typically are going to be through second lien. We're not seeing as much mezz, but there still is enough for this, especially for the smaller end of the middle market. I would also say that for all senior deals, we're seeing mid to high 4s, close to 5 times for all senior. It's hard to sometimes tell where all senior starts and unitranche begins, but that's kind of based on where you see pricing. So an all senior might be defined as kind of an L plus 450 to L plus 500 spread, and if it's north of that, you could call it a unitranche. In terms of the actual terms that sponsors are looking for, I would say the operative word is flexibility. That comes in the form of acquisition baskets, covenant cushions, and particularly EBITDA definitions. One of the things that we're seeing an expansion of is the number of pages that it takes to actually define EBITDA adjustments. And the biggest complaint I'm hearing from lenders is how add-backs are calculated. There's been a lot of creativity, let's put it that way, in that regard. But I could say that sponsors are looking for that flexibility, and given what I described at the top, with regard to the timetables compressing and the due diligence rush, the idea to kind of figure out how we can add to the EBITDA to make our purchase price look better there's obviously a trend there. And lastly, I would say that the volume has been pretty good. I think some of the data charts that you see, both from SCP and from others, Thomson Reuters and LCD, have shown the fourth quarter being somewhat soft. I think that may be true, although we're seeing pretty good flow. I think part of that has been the fact that there are the club deal is alive and well, where sponsor-friendly finance institutions like ourselves have been around for a long time, are getting plenty of opportunities. In general, I think the flow is probably off a little bit. It'll be interesting to see, and we'll talk at the end of this presentation about the outlook for 2016, but from our perspective, it does look continue to be pretty bullish. So with that, I'll pass it back.
Randy, just a quick question for you. This is Michael Manley. Back in the 2005 to 2007 timeframe, when we saw a frothy market where there was perhaps compressed due diligence and sort of light on reps and warranties, some of those came back to bite some of the finance companies. Do you anticipate some of that happening? Are you seeing any potential traps for the unwary that we might want to share?
Well, I mentioned the first was the amount of equity to capital. One of the things that we saw in 05, 06, and 07 was the percent of capital that was going into those deals was significantly lower, so I think that's number one. Number two, I think everyone who went through that cycle is aware of the kinds of companies that you can lever and the kinds you can't. So I mentioned this have and have-not bifurcation in the market. I think what lenders who have experience are doing is they're looking at those companies with exactly what you said in mind and trying to figure out, is this a company that will cycle? If it is, then it doesn't deserve the kind of terms that you're talking about. And if it is something that will cycle, that's why people are looking very closely at covenant cushions. So if we get into trouble, how much room do we have? And the intercreditor agreement. You know, if we get into trouble when we're first lien, what are our rights relative to the second on the note?
Very good.
Randy, I'm intrigued by this concept of have and have-nots as well, particularly if the distinction is largely one of scale, and that scale produces varying options for leverage. Are the differences dramatic enough now that it's driving a version of roll-up just to access better debt terms, or?
Yeah, I think so. And so sponsors are focused on the roll-up, one, for that reason. Two, because in getting to a purchase price multiple that upon exit will make some sense, they may buy company A as a platform business at 14, 12, 11, whatever times, but their goal is to add 3 or 4 or 5 different add-ons at more reasonable multiple 4 or 5 times, so they can average it down. But I think this drive to expand via add-ons is huge for those 2 reasons.
Very good. I think now we'll move on to the next segment of our presentation. Raphael.
Thank you. I wanted to thank Venable for having me here today. If we could move to the first slide. I want to start by taking a step back and looking at some of the historical contexts which inform where the private equity financing market is today. There are 3 main trends that I want to point out today. The first is the chart on the left, which shows the bolus of private equity fundraising that started in late 2005 up until mid-2008 at the time of the Lehman bankruptcy. Those funds are now out of their investment period. Keep that in mind. The second trend I'd like to point out is on the right, and shows the increase in the holding periods for portfolio companies of private equity funds after the 2008 recession. So you can see there how the average investment hold period has almost doubled from approximately 3 years in 2008 to close to 6 now. Next slide, please. This leads us to the third trend I want to point out, which is the development of or further development of a secondary market solution to address what I want to describe as the tail end problem. Right, according to Preqin, the buyout funds and growth funds raised between 2006 and 2008, that cohort I was talking about, we still have $548 billion globally in unrealized value. Roughly 1 in 5 of these assets are managed by firms that have not raised a fund since 2008. So in other words, you could consider these the true zombies. By contrast, between 2012 and 2014, secondary funds raised $69 billion to address these tail-end funds and provide alternative liquidity solutions to LPs. So again, if you knock out the 20% of that $548 billion that I mentioned previously, you've got $440 billion of assets being managed by firms that have raised subsequent funds and are not zombies against almost $70 billion of additional capital that has been raised to deal with this. Now, mind you, this trend is somewhat tempered by the capital overhang that Randy mentioned, but I don't think it's quite as simple as saying, great, well, more capital was raised in Fund 3, and so that can buy out the assets of Fund 2, because as you guys well know, being lawyers, most sponsors will want to avoid those cross-fund issues. And so the takeaway here is that as the 2006 to 2008 cohort gets closer to the 10-year mark, LPs and GPs are going to have to sit down and discuss their options. Some are pretty straightforward and simple, like issuing a fund extension or doing an outright sale of LP stakes through the secondary market. But others are going to be a little bit more complex, like doing a GP-led restructuring or some other form of hybrid fund purchase model. Now, mind you, this topic alone is worthy of its own webinar, but suffice to say that these options are complicated. They involve reevaluating a complex portfolio of private equity assets, negotiation between multiple constituencies, and very complex corporate and legal structures. So, sort of recap here, what does this all mean for private equity-owned businesses? A, the funds that were raised in the 2006 to 2008 periods are now out of their investment period, as incidentally are funds in 2009 and 2010 and almost 2011 at this point. B, investments are now being held for much longer periods of time, almost 6 years on average. And C, that you've got a secondary market that's grown significantly over this period. But mind you, the universe of potential suppliers is still much greater than the supply of available capital, and these transactions can be challenging to execute. So the result is that in situations where private equity-owned companies require additional equity support, not talking about debt, many of those funds are under-reserved because they didn't expect to still be invested in that company. And so they have limited options for achieving liquidity for their LPs. So how are private equity firms continuing to support their portfolio companies other than simply by investing additional capital from their funds? At one end of the spectrum on the left, we have what I call liquidity-based solutions. So put it simply, these are capital call lines and subscription lines mainly provided by commercial banks. The good news is that these are cheap with an interest rate of roughly 3 to 4%, relatively simple to underwrite, execute, and document. The catch is that the PE fund itself must have remaining dry powder to obtain these, about 1.5 times the size of the outstanding balance. In other words, as long as you already have liquidity, banks will give you liquidity. These are generally meant for bridging LPs' capital calls for short periods of time, but sponsors are increasingly using these liquidity-based solutions to bridge capital needs at their portfolio companies. Good example of this is, when they're going to realize synergies from their latest tuck-in acquisition or a cost-saving program that will eventually allow them to chin up to the EBITDA and therefore get a regular way standalone financing. At the other end of the spectrum on the right are what I call the enterprise value-based solutions. This category includes everything from structured equity, mezzanine with warrants, or as I call it, equity, and venture debt. In other words, everything from beyond simple straight rate debt, but just before minority and control equity. So these instruments all carry return expectations that approach those of equity, either through high coupons, warrants, or a combination of both. Stefan alluded to some of these as well. While these instruments typically dilute existing investors and are much more labor-intensive to execute, they don't place any restrictions on the fund's ability to spend their dry powder. Finally, we come to a third approach that I call the white space hybrids. And these are instruments that combine some of the elements of the liquidity-based solutions and some of the enterprise value-based solutions. It's still a very nascent market, and the approaches are faster. The cost is generally going to be between that of a liquidity-based solution and enterprise value-based solution. Now, from an underwriting perspective, these investors all understand that the real credit is an entity that is ultimately illiquid yet highly solvent. Some of the different approaches that I've come across include loans backed by the GP's value of the carry in the fund, or preferred equity at the fund level, or even loans made to a fund to help lever new investors as part of a GP or fund restructuring. While each of these has their own pros and cons and probably merit their own webinar, I can probably do a better job of describing the approach we employ at Enhanced Capital with the Arch Note, which is we make direct loans to individual portfolio companies
supported by the fund's NAV, not its dry powder. Credit support that's provided by the unsecured guarantee of the fund's portfolio allows us to provide straight-rate debt terms in situations that it would have otherwise required equity or an enterprise value-based solution. So far, we think this is a sound approach which provides us with a different lending strategy, and the PE sponsor community tends to like it.
Any questions from the panelists for Raphael?
Just on Raphael, on that last point that what you're doing, which I think at the Arsenal is a pretty exciting thing. Are you cross-collateralizing the assets of the other portfolio companies within that?
Well, in the true technical term, we're not cross-collateralizing because the guarantee is unsecured. So we're not taking a pledge of that equity. However, generally speaking, from an underwriting perspective, that is part of our underwriting thesis. So
you look at the leverage of the other portfolio companies.
No, we look at the equity value of that private equity fund's interest in those other portfolio companies. Now, as part of the underwriting, we will consider the leverage and where these similar value companies trade. Right? If something's trading at 10 times and it's levered through 8 times, yeah, that's going to give us it's going to inform our view on what the value of that individual asset is. But we're ultimately basing ourselves on what the auditors are signing off as the carrying value of those individual assets.
Randy, I'm curious, given that one of your points was that you can get comfortable with higher multiples on the debt side because of the amount of equity, if then that's happening on the front end and on the back end, the sponsor's leveraging up its equity, what's your reaction to that and how does it fit into your observations?
So one of the things that we think a lot about, and I think a lot of lenders are focused on, is who's your partner in this. So, and this can be not just the back-end leverage, which to your point is absolutely an issue, but also the age of the fund, where they are in the fund, whether it's an old fund that they're wrapping up or a new fund that they're just creating, because the dynamics, and I think we touched on this, Raphael, was the crossing of funds, because obviously we've seen situations where the sponsor couldn't put more money in and they were sort of backed into selling the company or reducing the shares. So it's absolutely, Chuck, a key factor. As important as the credit itself is the features of the sponsor and how much capital they've got to, fix the problem to the extent there is one. Goes back to the point, Mike, you touched on with regard to credit cycles and where you are and how you evaluate that. And a big part of that is the track record of the sponsor and how they behave. So, yes, it's a critical part.
Let's put a different spin on it. I think that the sort of transactions that Randy was talking about generally goes hand in hand with new LBOs, which is most likely happening out of the latest fund. Whereas the situations that I'm talking about are in reference to the older funds, where they're probably not adding new platforms at that point. They might be adding tack-ons, but they're not doing new platform investments. And so now they've got a situation where, geez, can we continue support with additional capital for our existing platform portfolio company, or do we sell a stake, or do we do something that is ultimately, no matter how you slice it or dice it, that's ultimately diluted?
All right, thank you very much. I think that brings us to our next panelist, Mr. Chuck Morton.
Thank you, Michael. And what I hope to do largely is to share some of my thoughts about why all this matters, and ideally the other panelists will weigh in, because it's one thing to look backwards and try to predict at what rates have been and what's happened in the market. And I want to spend a couple minutes getting us to look forward a little bit. And picking up on our last discussion, I'll mention the last bullet here, helping to align LPs and GP interests. But let me contextualize it in a minute based upon what Raphael just shared with us. My view is that the private equity industry is at a time of great maturation. that in part fueled by the fundraising that we've looked at today and the natural time horizon of these funds and the growing sophistication of LPs and the relatively anemic returns that people expect in the public markets, that you have this confluence of events that are happening right now that make it very difficult for private equity professionals. So in A Life, I wear a hat as an LP, as a fiduciary of the university-related endowment. So when we're trying to build our investment portfolio around our alternatives, we are looking only for top quartile performers. And our advisor would shudder to recommend anything to us that was not a top quartile performer. The problem, of course, of being a top quartile performer is that even in a world of gifted marketers, only half of the private equity funds can make claims to being top quartile performers. And that means that at least half of today's funds are on their last fund. And that's a sobering reality. That's one of the factors that gives rise to Stefan's observation of fundless sponsors becoming an increasingly important part of our community. There are many very bright, talented investment professionals who, for whatever reason, were not in the top quartile of their last fund, and now they're still determined to make a living, and they're trying to do deals. So often it's fundless sponsors. But that means that as these funds, as Raphael describes, later stage funds, struggle to end responsibly, that there's all kinds of challenges in aligning GPs and LPs' interests at that time, because ours is an industry that's based upon assumptions about critical mass, being a particular size so that the economics work and people are able to do the things that they've committed to do. So what we are observing is lots of funds struggling to try to create this alignment. Sometimes at the front end, more awkwardly the middle stages. Raphael's the solution that he just described we view as an interesting part of that ongoing discussion. But that's a macro trend that is influencing, I think, what all of us are doing. It would be somewhat curious to hear others weigh in on that observation.
So I think you're spot on, Chuck, with those observations. I think, though, when you look at the industry as a whole, one of the questions to ask is how many private equity firms are out there. It's kind of like thinking about the number of banks in the United States. So, 20 years ago there were 13,000 banks, and now there's 7,000. There's still a lot of banks, right? Right. Private equity firms, I don't know, 2,000 to 3,000. I mean, depending on how you define them and how big they are. I can tell you that our focus is on 150. Okay. So, and we've focused on those because over the last 10 years we've figured out who the ones are that have the best track records, who the ones are that have the best underwriting standards, who the ones are that are most successful. So to your point, yes, I think PE is maturing, and I think returns are being chased. But that will mean that again, sort of the have and have-nots. I think that you'll see a bifurcation between credit that chases the haves and focuses on those, and then the others are going to have their struggles. And I think with the secondary funds, I think that's going to be an issue as well, because if we do hit a recession, the thing that they lack is the ability to have reserve capital available to fix problems. And I think that's a key factor, because we know with middle market companies stuff happens, and you need that sponsor who's willing to vote with their feet and say, yes, we recognize there's a problem, and we're going to fix it by helping to get the company past the point where they are now to fix whatever the problem is that we need. So that's my, I don't know, Stefan.
I think these are great points. I mean, it all comes down. We're talking macro trends. We're talking specific instances. But there's a lot of deals out there that let's talk about one other thing. We talked about zombie funds, funds that aren't going to go out and raise capital anymore. To use your cohort, half essentially of all the funds that are out there. There's no doubt that there is a liquidity issue for those entities. The other thing that's going on is that the LPs of those entities don't want to continue to pay management fees when they thought they were going to be out in 10 years. And now all of a sudden it's year 13 and, they're still paying because they've extended or whatever. So you've got to get capital into these companies. And it's not just about, and, one of the things that goes on, and we talked about this briefly when it comes to recaps, what recaps get done, what recaps don't get done. If you've got an old fund, you're not going to put any more, you're on Fund 5, and Fund 2 has got this asset, and they want to recap it, no one's going to put money into that deal. It's very tough to get recapped dollars in an old deal where there's no source of liquidity for that entity. Whereas, to Randy's point earlier, if it's a relatively new vintage fund, there's a lot of dry powder, people are going to be pretty, comfortable giving recap dollars into that. We're working on some deals, especially in the oil and gas sector, which if you want to pick a lousy sector right now for liquidity, oil and gas services would probably be a good one. And what we're doing there is we have an entity for one of our clients who's got a company which, like everybody else in the sector, is over-levered and not generating the EBITDA that it was 3 years ago. And that's just obviously situational associated with the sector. They need to get capital into this entity. It's not financeable on its own, but they may have structural impediments to doing something that's cross-fund. So what do you do there? You can't solve it at the fund level. You can't solve it at the portfolio company. We did a weird thing, and we're in the market with it right now. We've gotten some nice interest. This company needed certain assets. So we had the sponsor put in a certain dollar amount of equity contribution into a special purpose vehicle, an SPV. We raising money against that SPV. And we then will have an assignment from that illiquid company of its contracts because it leases that equipment. So we have cash flow, we have an equity contribution, and we've created liquidity in this level, and it's candidly, it's bankruptcy remote because it's not part of the other entity, which is nice. And then to throw on it, we borrowed a little bit from Raphael's playbook, and we had a keep well agreement between the GP and the portfolio and the SPV, so that if in fact for any reason it can't meet its demand, there is a limited, not guarantee of the debt. We're not looking for that credit, but just a cash flow maintenance of fixed charge cash flow coverage and a keep well. So there are different ways to go about it, and that really was, I think that smart money today is identifying how to get a great return in a situation that's a little bit asymmetrical right now.
Which I think gets exactly to the second bullet here, that perhaps the most direct impact of some of these challenges is that folks are having to come up with more cash, sometimes creatively in side pockets where the cash feels a little bit more secure than it may in other places, and more contingent pieces or rollover pieces, just to try to get lenders comfortable and just to get deals done. As we look forward, I think we've already heard a little bit about expectations for Q4 and going into next year, but I think that there's a widespread sense that that's going to be more expensive, more difficult to get, and that's going to ripple through in lots of interesting ways through the market. Is anyone willing to venture a guess as to what rates will be as we sit here 12 months from now?
There is one point before we get into actual sort of Fed monetary policy, but Randy said something earlier, which I think I just want to elaborate on it because it really is so important. In response to Michael's question, he had said that the difference between 2004, 2005 vintage, when you're putting a company and you're doing 6 times leverage, and in this environment, even though we recognize there are some constrictions, going forward on leverage, the difference was in this time period versus that time period is that these deals are capitalized 50, 60% equity, whereas, before they were 25 to 30%, capitalized. I would say there are challenges, but it is a smarter market. Lenders are not going into deals. No one's going into a covenant light with a company that's going to cycle through. That's just not done for those credits. And no one's going into a deal with 25 or 20% equity if they're going to be leveraging it up 5 or 6 times, because at that point your fourth turn of leverage is equity risk, not debt risk. And I think people recognize that. So there has been clearly a change, in that regard. With respect to monetary policy, I think the last that I had read this morning, 92% of private economists expect liftoff at the December meeting. So we are going to see higher rates. I think most people anticipate a 20 to 25 basis point increase, and increments, to the extent they happen, will be in that sort of 20 to 25 basis point range. That's pretty much, I think, what anybody can project right now. Sadly, when you have a political event like what happened in Paris, it's going to also change, the markets. That has a very profound effect on liquidity as well. And it will also impact into Fed policy as well.
Well, I think the question then becomes what comes after December. And, it's been a while, so we forget what LIBOR was in June of 2007, 5.5% or thereabouts. So if the Fed increased the Fed rate by 25 basis points every quarter for the next 5 years, we'd just be getting to 5.5%. So I think the question is what happens after that. Is it a one and done? Do we sit and wait? But I think in the meantime, I agree with you. I think that the markets are still going to be pretty decent, albeit with this overhang that you mentioned. But I do think that, again, it comes back to supply and demand, and as long as there's capital coming into this private credit space in the middle market, which there is, I think you're going to see people filling the void as banks get out. I think that people will be increasing their hold levels. That's another key advantage to some of the funds that are being created that can put money to work in multiple pockets. So again, it takes the deal out of the market in terms of market risk and syndication risk. And I think that arms race, if you will, to create higher hold levels is, again, beneficial for the sponsors. They will create clubs. The definition of a club is now much higher in terms of size than it used to be. It used to be a $50 to $100 million deal with a club. Now a club is $200 to $300 million, even higher than that. So I think from an issuer's perspective, it still will be a very attractive market next year.
Oh, sorry. We're running short on time, and there was one question I wanted to get the panelists to respond to. So quick last remarks, Raphael?
Oh, no, I was just going to add to, my predictions for the future. I think I'm going to echo what a lot of the people said, right? But, while big picture, right, I will paraphrase J.P. Morgan when asked what the markets would do. He said they will fluctuate. And that's obviously, it's hard to have a crystal ball. I do think that some of the structural elements, big picture items that we discussed today are going to continue having a bearing on the markets long term, right? The overhang that Randy mentioned is going to result in higher equity dollars, higher equity percentages, which is a function not just of that overhang, but also of, I think there's greater operational expertise on behalf of the sponsors because they know they can't achieve their returns purely by leverage. They need to have industry-specific knowledge. I think that you're going to continue seeing an a bifurcation of the market in terms of the haves and have-nots, not just on behalf of the sponsors, but also on behalf of the credits, right, in terms of hold sizes having a bearing on that. And what I always describe as credits that are CLOable and credits which are not. And there will be a vast bifurcation between those two worlds because, they speak to very different constituencies and abilities to syndicate risk.
I think we're running short on time. There was one quick question from the audience asking how can they be added to the newsletters. So, Stefan, you want to tell them quickly, and also Randy?
If you go to our intro page, our email addresses are on that, so.
Yeah, that's the best way.
Yeah, but I think between Randy's and mine, two of the best out there.
Yeah.
When, for instance, unitranche, for Randy did a 4-piece series on unitranche. There really isn't a lot talking about unitranche, and there's a lot of, I think, mistaken concepts about what a unitranche is. That's a very good source to go to. For the S&P market update as well, you just go to our website. You can download it from the website or just subscribe to it on the website.
Very good. Well, I'd like to thank our panelists for a very interesting discussion. Thank you so much. We hope the audience found it interesting and useful. And tune in next time for the next in our series. Thank you very much.
Thank you.
Thank you.